Welcome, everyone, and thank you for spending some time with us today. My name is Ryan Staton. I'm one of the managing partners here at StatonWalsh. Today's presentation, we're going to talk about our normal quarterly state of the markets, but sort of a halftime report as well. What happened over the first half of the year? It's been a busy month in July as well, and now into August. And so we're going to talk a little bit about what happened during Q2, and then also some things that happened shortly after that, and what to look forward to now and until the end of the year. For those that attend these sessions on a regular basis, I always like to do something a little funny or silly to start things off. Um, the big headline news at the beginning of July was the passage, signing into law of the One Big Beautiful Bill Act, um, something that I am now going to have to say repeatedly in serious conversations. So I've said One Big Beautiful Bill or Big Beautiful Bill or OBA, trying out a couple different options here, but it's going to be a topic of our conversation today. There's a lot in that legislation that is relevant, both from a market perspective, but more importantly, from a financial planning perspective, for those that either own businesses or retirees, and then everything in between as well. So let's talk about what happened in the market during Q2. So this data or these statistics are as of June 30th, but year to date, we had a rough start to Q2. You could see there in April 2nd, infamously known as Liberation Day, or the rollout of tariffs by the Trump administration. Sharp reaction initially to that. As you could see, bit of a bounce back, pretty good bounce back in most major market indices. And so as of the end of the second quarter, we saw an uptick of close to 18% for the NASDAQ composite, 10.94 for the S&P 500, and 5.46 for the Dow Jones Industrial. Looking to the right, these are measures of global performance or global indices. And so MSCI, we have all world without excluding the US, so without the United States and United States indices, was up 12.33%. Emerging markets, smaller countries around the world, up 12.2%. And then the MSCI EAFE, which is, I think, developed countries, a large chunk of Europe, some the more developed parts of Asia, the total return there was 12.7 for the quarter. So all in all, positive quarter for markets, rough start out of the gate, but a pretty sharp and pretty drastic rebound by the end of the quarter. Unpacking what happened in the various asset classes. So you can see here year to date, 1 month, 3 months, 6 months, kind of drags that out over a 10-year period of time. What you could see year to date, and something that has been atypical in recent history, is that the international markets, the U.S. markets, I don't think it's any secret, have outpaced international for an extended period of time. And you can see here on that 10-year total return, world ex USA, 7.2, US growth stocks have been up about 17% during that same time frame. Um, what we've seen this year is sort of a reversal and a flipping of the script, so to speak. So the world ex USA is up almost 20% year to date, emerging markets being up close to 15.6%. And the S&P 500, as of the end of the second quarter, was about 6.2%. All of these have migrated up slightly since that point in time, but a different story being told this year about how the rest of the world is performing from a market and an equities perspective in comparison to the United States. And so you could see some of the other asset classes. US growth has underperformed the larger index. US value slightly behind that. And we do start to see an uptick in certain areas like real estate, treasuries, and the like, although modest. Year to date, the asset classes that are down, municipal bonds slightly, and then US small cap stocks. So let's revisit the first half of the year, zooming out, not just, pretty good second quarter all in all. Year to date, we're seeing positive returns in a lot of major market indices and major asset classes. But let's look at what happened over the course of this year. And so, in the United States, the S&P started this year sort of on a high note, a little bit, I would say, a modest rally to kick the year off. And so, February 18th, we had the peak of the post inauguration rally. We started to see a little bit of a downturn after that. April 2nd, US launches further tariffs, sharp decline. April 9th, a pause on those, sharp rebound. And then we've seen a modest uptick again since that point in time. Um, there's been some other events in the mix as well. There was some conflict with Iran, again, short-lived. U.S. and China on May 11th did strike a deal or a trade deal on reciprocal tariffs. There's continuous conversation on this topic of tariffs. Where will things land? There's been a pause, a restart. There's been a lot of back and forth. And as we've seen, sharp negative and positive reactions to the news. But over the course of the first half of the year, we've had a lot of what we'll call triggering events, some short-term reaction in markets, and then sort of a stabilization of performance, primarily from I shouldn't say performance, behavior is probably a better word to describe that. And so, a lot of reasons and a lot of things in the news cycle that have kind of been swirling and continue to swirl and have created some uncertainty and some to some degree some anxiety amongst investors in the market. And we're going to talk a little bit about the macroeconomic data and where that lands here in a minute. And so, transitioning to macroeconomic data, where are we? Inflation and CPI, core inflation has been steadily declining or decreasing since its peak in 2022. We could see now that the US inflation rate is down to 2.67%, core inflation is 2.93. And so this has been a big driver of Federal Reserve policy. So there was just a meeting last week or the week prior on Fed policy, and there's been a lot of conversation on what will they do. Sorry, it was a week ago. What will they do? And will they reduce interest rates? Will there be cuts? What effect will that have? And they made the decision in the July 31st meeting essentially to pause, to do nothing. There's still an anticipation that rates will be cut. Inflation is a big driver of that, though. There's a target inflation rate that they're looking at. We're slowly getting there to that point, and that's something that ultimately will be a continuous topic of conversation. Several more Fed meetings to finish the year out, and so there is an expectation that there will be some form of rate cut. When and how that happens remains to be seen. And it's no secret there's been some turmoil between the current administration and the Fed chair Jerome Powell on what they would like to see versus what's happening. And so more to come there. I think a lot of it's playing out in the news cycle. And so we'll all be seeing it play out, right in front of our eyes. In terms of um, wage growth, U.S. average hourly earnings are at about $36.32 as of today. The real average hourly earnings, this is adjusted for inflation, is about $11.30. And so, we see that average hourly earnings year over year are up about 3.7%. Given, incorporating inflation into that mix, it's about 1.07%. And so we're still in this place, and we were in this place in 2022, especially during the peak of inflation, as you see here up in this top left chart, where we were basically net negative on inflation was up, wages were not. Wages were up slightly, but incorporating inflation into the mix, American households were not able to keep up with inflation in the form of increased or cost of living adjustments through income. And so, although our averages have increased pretty significantly even since 2020, the average hourly wage being about 36 bucks, with inflation and with some of the cycles that we've gone through, it just doesn't feel like we're keeping pace. And I think we talk a lot about inflation and 2.67 and 2.93, those are universal measures of inflation. The reality is we all have our own different expectation or our different feeling of what inflation actually is. Inflation is relative to how you spend your money. And so if there's a certain segment like groceries or other consumer goods that are experiencing higher rates of inflation in your area, or the specific types of items you're buying, this 2.67 or 2.93 really don't feel real to you. They feel like numbers that are not relevant and don't play out in the real world, while others may say or may feel that their rate of inflation is actually less. And so, there's a lot of conversation around these topics. Wage growth. A lot of state legislatures have made it a focus to increase things like minimum wages and the like. And to some degree, it's a tough economic balance between how do we make more goods in the United States when we talk about trade and tariffs. How do we increase earnings for American families while also keeping things like inflation and the costs of those items at bay? It's a challenging juggling act there, and one that I think is going to continue to be relevant, very much so for the rest of this administration and probably for the next as well. When we talk about unemployment, this is something that has been one of those causes for concern. We see that unemployment was at a low of 3.4%. It started to tick up slightly. It has not been a sharp increase, but it is something that is of particular interest for many economists, and is something that's starting to get talked about more and more. The Federal Reserve talked about it in their meeting last week as well, about concerns about economic activity, concerns about economic indicators specifically, and unemployment rate being one of them. Generally speaking, when we look at, where it normally sits, the averages over time, it's still relatively low. But that uptick, if that continues on the trend, I suspect there would be more conversation, not just around Fed policy, but other policies as well on how do we keep that at bay and continue to create more jobs. Jobs numbers have not been favorable. Again, another point of contention. There's some argument about what data is accurate and what's not. But the general feeling is that there have been some changes in the workforce, mostly in reductions with some companies, especially in some industries in particular. And so that's been a point of concern. When we look at job openings, we've seen a pretty sharp decline from that high of 12 million. Now we're at about 7.4. Uh, you know, Correlating that to labor force participation rate, we're still below the pre-COVID levels of labor force participation at 62.3%. And that's something that has not really been a point of focus, but it is a valid talking point in terms of there are some openings. We do have some people that were participating in the labor force that are no longer doing so, and not because of retirement or other reasons, primarily just a choice of non-participation. And so how do we fill those openings? How do we reduce unemployment? All things that for the folks in DC to figure out, but all things that will directly affect outcomes from an economic activity perspective. Um, Looking at layoffs and discharges, again, small upticks there, not huge changes. Look, these charts look relatively flat for all things considered. But as you could see over here, we do see a slight uptick in unemployment. We are seeing some layoffs. These are total non-farm specific jobs. There have been some layoffs with some large organizations that have made the news, specifically in the tech sector. So more to come on that. Not particularly alarming yet, but it is something that we're seeing an upward trend, and typically upward trends in unemployment means we're going in the wrong direction. When we talk about GDP, and some of the other numbers here, one of the things that has been a particular point of concern is the ratio of public debt as a percentage of GDP. Public debt has skyrocketed in the past, really 10 to 15 years. And you could see a pretty sharp uptick when you see here through the 70s, 80s, 90s, gradual increases. We've seen a pretty sharp increase. A big part of that has been, increase in housing prices. Much of the debt that the U.S. public carries is in the form of mortgages. But with the peak or the spike of interest rates during 2022 and the combination of increased debt and service on that debt, you could see here in that gray bar, we've seen a pretty sharp uptick of debt balances, 36.2 trillion to be exact, compared to GDP, which is about 29 point or almost just around $30 trillion. And so when we compare the two together, we have a lot of debt compared to GDP. And so, the ultimate goal would be to increase GDP or gross domestic product here in the United States. Um, but the other point of concern and why there is such a heavy focus on things like Fed policy are not just debt as a country, which is important. Our interest service, our interest carry on our debt as a nation has become cumbersome and could become more cumbersome if we don't get some relief on rates in the short term. But more importantly, as a U.S. household, our ratios of debt in comparison to take home pay and factoring in things like higher mortgage rates, higher home prices, there's a lot of risk swirling out there in the marketplace, and not necessarily in the housing market specifically, which we're going to talk about next, but more importantly, just that look and feel of how is inflation affecting my household? How's it affecting my cash flow? Do I feel like I have the ability to get ahead, or do I feel like I'm treading water? And so these numbers are indications of some of the feelings that many folks have of we feel like we might just be treading water and we need to figure out some kind of reprieve. So, this is what the data is telling us. GDP is up, which is positive, sharply up after COVID, but debt is also following, and so it'll be important as time goes on to keep that at bay. Cuts in Fed in rates, Fed policy could certainly help with that, but increased economic activity through GDP and other production here in the United States could also help with that as well. Housing. Points of focus here, things that I would point to: average 30-year mortgage rate floating around 6.77%. This is as of the end of June. They've come down slightly since this point. Average 15-year rate about 5.89. Mortgage origination still down. Housing market and kind of heard from many people out there that it's felt a little slow, all things considered. And I think primarily we're looking at a situation where when we talk about housing prices versus mortgage rates, both have gone up in tandem, which has not been the conventional expectation, but that's just the reality of what we've all been living through. And so that's something that has been a challenge for the housing market. You can see here mortgages delinquent by 90 days or more. We often get questions about things like housing bubbles. Is that relevant? Is that real? In comparison to where we were in the 2008, 2009 economic crisis and the housing bubble that burst then, we're way, way off from that point. And so, a lot of regulation introduced into the mortgage industry that I think to some degree prevents mortgages being offered to the same folks that were delinquent during those times. It was just a different way of doing business. The mortgage industry was completely different. Excuse me. Mortgage delinquency is relatively low, slightly up from the bottom of 0.37, but we're still at about 0.86. So not at this particular point in time, not really what we would feel is a relevant statistic and something that would be a cause for concern. But rates have held steady at uh, a higher percentage for an extended period of time, and so that certainly has provided some challenges in the housing market. The other thing we see here, you could see median home price. So, we see the fluctuations over time. We saw that downturn post-recession environment in 2008, 2009. Once COVID hit, we saw a slashing of interest rates and a acceleration of home prices. And so this chart on the left actually shows median sales price for new builds versus median sales price for existing homes. Typically, new builds, new houses built, you could see there was a pretty wide gap here for a long period of time. Existing homes are actually selling on average for more than new builds right now. Now, a part of that is that there weren't a lot of new builds or housing starts happening. But the other interesting part of this is that existing homes in established areas, it's also about inventory too. What's available, what can be bought, and so we're seeing less inventory is certainly driving prices higher, and rates have not really affected that a ton. So we had a crossover point during last year's cycle, and now we're at a point where existing homes are averaging selling at a higher price, only about $10,000, but albeit higher than new builds. And so if you've heard the phrase from folks, it's cheaper to build a new house right now than it is to buy an existing one. Theory, that's true. And so something of particular interest, definitely atypical if we see historically. There have been instances where this has been the case, but uh, it's likely that as long as we have sustained higher rates, there will continue to be challenges, and there does not seem to be any specific expectation of housing prices coming down in any significant way. Um, so for those that are looking to buy a house and are hoping that rates come down and somehow prices also go down with that, it's unlikely. It seems to be unlikely based on the data and also just the general consensus of what's out there in the marketplace. So, if anything, a reduction in rates, anything drastic or dramatic, will certainly increase. It will increase supply, but it could also increase demand and competitiveness on certain homes in certain parts of the country. So, um, when we look at houses sold, uh, one of the reasons why this average has exceeded new homes, you could see here. Existing homes sold were about 4 million and new builds were about 623,000. So drastic difference there, pretty big spread, and definitely something of note, as of that was as of the end of May this year. So let's talk about how we feel as consumers. So when we look at retail sales year over year, um, real retail sales pretty much flat, just under 1% of growth. Um, these two things have gone in tandem and have gone hand in hand for quite some time. You can see these lines kind of follow each other. There has not been uh, I would say a great feeling of positive sentiment. You could see the average on consumer sentiment index is about 85. We're floating at around a 60. There's been a lot of up and down post COVID. We saw some positive interest rate spike in 22. We see some negatives. We've been clawing our way back, but we flipped the calendar year over this year, and consumer sentiment has lagged primarily because there's a lot of uncertainty. There is a sense of uncertainty out there in the marketplace. It definitely has reflected in economic numbers and activity in general of where people are spending money, which sectors are seeing normal activity versus reduced activity, and primarily that is a byproduct of two things. One, stimulus money from COVID drying up and the additional savings that was available. There was a surplus for quite some time post COVID. Much of that has dried up at this point, and people are back to spending based on wages and take home pay. And there is some uncertainty about prices and economic activity. And so that certainly reflects here in overall consumer sentiment. So, talking about interest rates, as of June 30th, which not much has changed here, we are sitting at a Fed funds rate, effective federal funds rate of 4.33%. Um, has come down from its peak post 2022 increase. Has not come down as drastically, maybe as many would have expected or hoped. But generally speaking, we are seeing that the conversations coming out of the Federal Reserve that they do have an expectation of cutting rates. They're just not sure when. They did cut rates about 1% last year. It remains to be seen if they're going to do the same before the end of this year. They have a few more opportunities to do so, but I don't, based on the sentiment that's coming out of some of those meetings and some of the comments that are being shared publicly, it seems like we are all riding along together, waiting for some guidance on that. So we're kind of status quo with no particular updates. They've made it clear what they would like to see in order to cut rates. Those things have not come to fruition, and so therefore it's a lot of nothing at this point. Um, where this is going to be important. So we were talking about mortgage rates previously. Fed funds rate is not as important. It does have some role, but is not as important as a lot of other factors when we talk about how mortgage rates are determined. Mortgage rates more heavily tied to or related to 10-year treasuries. Um, this rate is relevant, however, when we talk about consumer spending, consumer debt, financing things like vehicles, credit cards, other types of asset purchase financing, and outside of the mortgage realm. That's where this interest rate is really going to become relevant. Certain types of lending are contingent on it or incorporated into their rate calculations. And so, the lower that goes, it's a long-term target of 2.5%. We're about 2% off of that. It's potential to come down that far, but that will be contingent on the Federal Reserve making that policy decision, and that will be heavily driven by their the things that they've weighed as important, like inflation, like economic activity, and also keeping things at bay so that when they do cut rates, we don't spill over into this another period of inflation like we did post COVID. So. More to come on that. There's a few more meetings coming up that we'll talk about here in a second. When we talk about Treasury yield curve, so why is this important? In layman's terms, longer term, so this 30-year Treasury rate, typically what we would want to see is the yield or the percentage on that be higher than the short term. Where we were for a sustained period of time is that short-term treasuries were paying better rates than longer-term treasuries. And the technical term for that is an inverted yield curve. It's usually an indication. There's a lot of people out there. Inverted yield curve is, the end of the world. It's doom and gloom. That didn't really come to fruition. That wasn't the case. And so the long story short is we want to see a normalized yield curve where shorter term interest rates are lower, longer term interest rates are higher. The cost of borrowing over a longer period, in theory or conventional wisdom, tells us that that should be more expensive. For a while, that wasn't the case. We're starting to see some normal activity in yields. You could see here, though, your 1 month, 3 month Treasury rates. A lot of those exist in, think money market accounts, short-term cash positions. Um, you're seeing four and a quarter, 4.41, 4.9, outpacing 10-year Treasury rates, which are about four and a quarter, 20 years, 4.79, and 30 years, 4.78. And so essentially, what happens in the bond market when this is the case is you look at return or risk. I have a shorter duration to earn more on my money, and with the ability to have liquidity 6 months from now and then potentially find a better interest rate or find something else in the marketplace. And so it's provided some strategic opportunity from an investment perspective. But as these rates start to come down, we will see that investment portfolios and institutions will start to have to go farther out on the yield curve to maintain interest rates that many have grown accustomed to over the past couple of years. And so we do see some normalization there. There is still this band on the lower end, under 2-year treasury rates that are flirting around the same as those in the 10, 20, and 30-year bands. But our expectation is as, as Fed funds rates go down and as some other things happen, it's our expectation that you would see some of these shorter term treasury rates dip and then potentially have longer term treasury rates actually increase in yield potentially or remain steady at their current rate. So let's talk a little bit about economic conditions about a year ago. And so this economic scorecard shows kind of like a speedometer: green, yellow, red, positive, neutral, negative. These are all based on effects on investment specifically. So, investment portfolios, how these could positively affect, relatively neutral or could have a negative effect. And so, if we rewind back to June of 24, monetary policy, economic outlook, yield curve, disposable income, interest rates, there was a lot of like points of caution. What should we be paying attention to? What could have a negative effect if the tide turns? And what has been generally positive on investment portfolios? So you see there relative mix of green and yellow, a couple reds. Equity market valuation was a big concern. Potential overvalued sectors or specific companies that had a pretty significant run up post COVID. And geopolitical risk was really the largest negative, and we've seen that play out a couple times over the past year. Um, in the short term, it's been relatively it's been a sharp reaction, but in most cases, the dust has settled and the market has rebounded or normalized back to where it was prior to those events. So 24, lots of things to be positive about, lots of green, positive impact on investment, a couple negatives and a few neutrals and things to look at as point of caution. Here's what June of 25 looks like. Most of the green has gone away, and two positive notes here are fiscal policy and credit availability. Everything else we are effectively neutral on. This is a forecast of a 3 to 6 month time horizon. And so monetary policy is a big one. Economic outlook, consumer sentiment, as we mentioned, is down. There's that feeling of real wages and real take home pay. Labor market, a slight uptick in unemployment. Where does that land? Housing and mortgages just really have not moved a ton. Interest rates have not moved a ton. We have some positives in the fiscal policy and credit availability, as I mentioned, but we're seeing a lot of neutral items of still possibility for a positive outcome, but just kind of sitting in the middle, waiting to see what happens. And so the two negatives that continue to linger are the equity market valuation and geopolitical risk. As I mentioned, we've seen geopolitical risk play out. There's always that risk will always exist to some degree. I think more it's more magnified right now just because of some things that are happening: trade talks, tariffs, some conflict around the world, and so outcomes there will certainly could certainly create some challenges in U.S. markets if these are at a larger scale or bigger reactions to some of those events. So we went from kind of half green, half yellow to now we're in a place where we're relatively neutral. I've used the term a bunch of cautious optimism. There are some things that don't look great, but they're not bad. They're not good, they're not bad. And so that's where we kind of arrive at this neutral posture. Some were neutral leaning positive. Most, with the exception of political environment, were kind of neutral leaning negative potentially. And so um, there's a lot to unpack from now until the end of the year. A big part of positive change was some legislation that was passed, the One Big Beautiful Bill Act, which we'll talk about the provisions of that. There is some good in that. There are a lot of things are very I'll say temporary, meaning that there's some positive impact in the short term, but because of the nature of it being a budget reconciliation process, they have to go away at some point or expire. So when those things sunset, the question is, what rules do we revert back to? And so at this point, we have some things that we're kicking the can down the road on. from an economic perspective and where we see the markets going um, for the second half of the year. So what's ahead for short-term interest rates? Federal Reserve meeting, they just had their meeting last week. Three more meetings coming up in September, October, and December. There is an expectation that there will be a cut or cuts. We don't know what that's going to be. Everyone floats around a quarter of a percent to a half a percent. Could be more, could be less. A lot will be that decision will be driven by what happens over the next month and a half. So let's talk about forecasts. I always like when we do our halftime report, we look at kind of what most people had predicted for the year. So, analysts are really good at making predictions. Those predictions a lot of times don't come to fruition. They're not necessarily supposed to. It's very rare that anyone's right on target. But these are some of the major institutions, major banks, and what they anticipated would be the close of the S&P as of the end of the year, the target for the year. And so Morgan Stanley, JP Morgan had it, and Goldman Sachs had it around 6,500. Um, we have RBC at 6,600. Bank of America, really very specific, sixes across the board. And then Deutsche Bank at 7,000. So the group average here was about 66.28 as the expectation for the S&P for the year. Now, at the end of May, it closed at 59.12. As of yesterday or today, it is at 63.43. So on pace with possibly achieving some of these targets. That um, the targets were relatively modest in nature. Again, using that term cautious optimism, a lot of analysts, I think, still feel and felt at the beginning of the year that there was a good possibility of market growth, positive market growth in the US this year, but more modest than what we've seen in years past. It's also important to have context. We've come off of two consecutive 20+% S&P 500 years. Historical precedent on that is limited. And so it's hard to have an expectation that US markets will continue to appreciate at that level year over year. So far, so general, summary there. So far, so good. A lot of year left, a lot of stuff still on the horizon, but there are some that were more optimistic than others. But generally speaking, in some cases, we're creeping up on some of these annual targets that a few of the analysts had. All right, One Big Beautiful Bill Act. So this was signed on July 4th, somewhat intentionally, but this is a big change and a big shift. And I'd say, the biggest effect that we're seeing is there are some things with high net worth individuals and business owners, especially on the estate tax side, charitable deductions, certain treatment of business taxes. Um, there is a lot to unpack there, and we'll get into some more of the specifics. There were some shifts, I would say major shifts. There are some things that we'll talk about in terms of planning mechanisms and some things that have been helpful. But they're not surprising. There's a polar reaction to that legislation. There are certain folks that are very positive and bullish on it, and some that feel that it missed the mark, that um, it hurts other segments, primarily middle and lower class families, with some changes to um, certain things like health insurance coverage and the like. What we're going to talk about today, politics aside, what provisions change and how that's going to affect outcomes for certain households and families. And so, um, the top tax rate was set at 37%. That's where it was based on the Tax Cuts and Jobs Act of 2017. Um, the difference is that that income threshold will now be $750,000 for joint filers. So there was an increase. The top tax rate was set at 37%. There was also an increase in the amount of income that would be needed to reach that top tax rate. You can see on the right hand side, this is just a history of top marginal tax brackets in US history. The average top marginal bracket is about 56.4% in its history. The lowest was really in its genesis, it was 7%. It's been as high as 94% during World War II, and has, historically speaking, is lower than its historical average and lower than it's been in quite some time, with the exception of a segment there in the 90s. So late 80s and 90s. And so um, this has kind of bounced back and forth between 39.6 versus 37, 35 at one point, um, and this is something that constantly gets talked about is marginal tax brackets. What do they mean? Who benefits from any reduction in marginal tax brackets? But that fixing of the 37 keeps the policy from 2017 in effect, at least until the sunsetting of this bill or this particular element of the bill. 2026 tax considerations for, high net worth folks, business owners, estate and gift taxes. High net worth clients now have a larger window. It's $15 million per person to transfer wealth tax free. That can be combined into 30 million for married couples. And so you can reevaluate. There was a lot of questions about, will estate taxes be relevant for me? Maybe, maybe not. Now, it's important to note that the state that you live in still matters. So here in Maryland, there are still state and tax gift tax limits. They are there are inheritance and estate taxes as well. Maryland's one of the lucky states that has both estate and inheritance taxes. Not necessarily relevant for immediate family members, but something um, that something still matters in planning considerations. And so there was an expectation that the end of this year that estate tax limit was going to be reduced. Part of this act was fixing or keeping those exemptions at a higher amount. Probably the biggest win for I'm kind of skip around here just because in the interest of time, I want to make sure we focus on the really really good stuff. SALT deduction. So if you lived in a high tax state, state and local taxes a lot of times could be a large portion of your tax budget. And so the SALT deduction was capped at $10,000 under the old legislation. That was increased. And I think this one has the most potential to have an impact, especially for those on the coasts that live in higher tax states where it really does not take a lot of income to hit that $10,000 limit when you factor in all the different tax being paid. And so increasing that limit and rolling that up, it's going to be about 40,000, will create some additional tax benefit at a federal level for folks where state and local taxes now can be deducted above that 10% or $10,000 limit where 10,000 was that previous cap. So that will be some temporary relief for middle income households, and definitely something that was, I think, a big win universally for folks that live in certain states around the country. The itemized deduction cap, standard deductions were held at a higher rate. There was also the introduction of a senior tax deduction, which we'll talk about here in a second. But further work was done to try to really eliminate or limit the amount of folks that were utilizing itemized deductions and really standardize and streamline the tax filing process. Charitable giving was something else. There's a new 0.5% adjusted gross income floor. This means that fewer people will benefit. This kind of goes along with the itemized deduction piece. Fewer people are going to benefit from itemizing charitable gifts. It kind of makes it where the standard deduction is going to be standard deduction and some other items are going to be larger impact, which will keep you from having to itemize and keep track of all those things, but potentially could create some short-term limitations or issues with those that are making charitable contributions. Um, this is a cause for anyone who has some charitable planning built into their estate plan may want to reconsider or look at some of those items and make sure that they still match up with at least what some of the changes have been as a result of the act. Um, we'll go high level on some of this. Bonus depreciation for anyone that's a business owner, being able to deduct 100% of the value of equipment or other types of items that had started to phase out or potentially go away. That has now come back, and that is something that will be relevant again. So 100% or bonus depreciation will be back, and that is a major shift. There's also enhanced qualified small business stock rules. Really, it just gets into capital gains and tax planning. Same thing with opportunity zones. This was a tax planning tool that could be used to reinvest proceeds from sales of businesses, real estate, whatever it may be. If you invest in a qualified opportunity zone, you got some benefits for that. It also had some mutual benefits for some of those communities, brought investment dollars into the fold so that they could build in disadvantaged areas. So, just a couple things, tax shift there. Just to wrap things up, kind of land the plane here, and then we have some time, so I'll open it up for some Q&A. Here's some general thoughts that I just had when reviewing all this. Forecasting economic and market outcomes is really hard, just to keep it short and sweet. Um, a lot of times we can use historical precedent to look at what's happened, kind of where we've been and where we're potentially going. Um, it is a common misconception. It's really easy to do. You can always say this time is different. Um, a lot of times that's an emotionally driven conversation to say like, well, this is different, or this is what's happening, or this is what's changed. There are some instances where that's true, right? Technology, artificial intelligence, certainly changing the way business is being done, the way things, the way that we're interacting. It's created some efficiencies. There is a concern that it could eliminate jobs. Generally speaking, it doesn't look like that's going to be the case on large scale, but there are a lot of things swirling right now where we could say, this time is potentially different. History really is consistently, and there's a reason why there's the old adage of history tends to repeat itself, is that believe it or not, as human beings, we study history, and the point of that is to learn from it and potentially change the future. What tends to happen is human behavior causes us to revert to what we know, and history tends to repeat itself. And so that's not to say that you can carve out some cherry pick data from a period of time and use that as your basis or your map of how to invest moving forward. But historical precedent has showed us that crowds tend to move together. And so if we can anticipate to some degree some of that, but more importantly, have a more structured approach and follow our own roadmap, that's going to lead to a greater probability of success. And so, maintaining discipline, avoiding temptation, especially with timing markets, there's always going to be opportunity. You don't know if it's the perfect time. April was a prime example of sharp downturn in markets. If you had some cash on the sidelines and you put it at play, maybe you were a day late, maybe you're a week late, whatever that may be, you still saw some positive, potentially saw some positive outcomes as a result of that. So, timing is almost impossible when we talk about markets, just because a news cycle, a tweet, whatever it is, it can stop things on a dime. It can push it in one direction or the other. Having a disciplined approach and understanding kind of outcomes and goals is much more important when we talk about investment outlook. Again, that goes to my point. Don't let short-term emotions disrupt long-term plans. Um, Simply put, have a plan, stick to it, adapt to the environment, but don't try too hard to predict the future. None of us have a crystal ball. Historically, and the data has proven we're not very good at it. And typically, those that have a structured plan in place, you're not always going to be ahead of the curve. I talk about the water cooler conversations. You may not have the best performing account, but if you're on track for doing what you need to do with those assets and with those dollars, that's more important than anything else. Most importantly, and this is hard to do, especially right now, and it's been hard to do for a while, do not let politics drive your investment decisions. Um, Time in the market. We do a politics in your portfolio for anyone that got a chance to see that last year during the election cycle. political and we see it right on both sides when the other party, the contra party gets elected, people say this is going to be bad. Half says bad, half says good, and we see everyone invest dollars, or no, I shouldn't say everyone, that's overgeneralization. We see people make decisions based on that. History, again, to my original point, history has told us that most presidential administrations, regardless of how you feel about them, in US markets especially, have yielded positive results. The one exception to that rule is the Bush administration, 2000 to 2008. Um, Three down market years to start the 2000s, and then a pretty sharp market downturn in '08. Um, Essentially made the market flat during that decade of time, roughly that decade of time. Really, 2000 to 2009 as a whole was a flat decade for US markets. And so there's a lot that happens in every presidential administration. When we zoom out, a lot of these things end up becoming blips on the radar. I'm not saying that that's always going to be the case, but history has shown us that having a plan, having discipline, sticking to it. Warren Buffett's a perfect example of that. Tremendous amount of discipline. He has rules that he follows. He follows those rules religiously. And we all, I think most people have probably heard of Warren Buffett and know the success he's had in investing in the market. He makes decisions from time to time. He makes very different decisions, and probably most retail investors should, but he has the capacity and the ability to do that. He's a multi billionaire. So, the point is that the most successful market investors tend to have discipline. They have a plan, they stick to that plan, and they don't deviate from it regardless of what's going on, regardless of political affiliations, and regardless of how they feel about what's going on in the world. And it's also important to note, just my final point here, take necessary risk. um, Taking necessary risks is something we talk quite a bit about. There's risk and then there's necessary risks. And sometimes you don't have to try to hit a home run. You don't need to chase excessive rates of return. You can have what we like to call a steady Eddie portfolio that works and that hits your benchmarks and tracks with your goals. And that could be enough. Again, it's not something you can go out and brag about, but it's about comfort. And so, comfort and success, and especially when we talk about planning and meeting our goals and expectations. So, with that, I will open the floor to questions. Feel free to use the chat. We have a Q&A as well. If you want to use that anonymously, you're welcome to do so. But appreciate everyone's time, and please feel free to ask any questions. All righty. Well, I'll stick around. I appreciate everyone's time. I know long presentation with a lot of information, recorded session, so everyone will get a copy. We'll circulate slide decks. We really appreciate again your participation. And if you have any questions, again, I'll stick around for another minute. But if not, or if you have any questions that pop up later, or stuff you want to ask offline, feel free, let me know. But if not, I'll give you a couple minutes back in your day. And again, thank you, and we look forward to seeing you on the next one. All right, everyone. Thank you. Enjoy the rest of your day.